Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the TGI. Thank God it's Friday, the 8th of April, 2022 daily webinar, the Bull versus Bear webinar with Trade Day. Steve Miley here on the call as ever. So welcome, everyone. Going to go through our usual normal run through, take a look at calendar, what we've had, what we've got coming up. We'll take a look at what we have with regard to going on the fundamentals, what's really impacting markets from a macroeconomic, fundamental, geopolitical perspective. Take a look at some articles from the major news wires. News wires. Yeah, new what? Yes, that's right, news wires. And then we'll take a look at the charts and what's going on the charts. So with respect to the calendar, light Canadian employment report today. Often it coincides with the US employment report. Sometimes it's the week after, depending on just the release date. So, but in today's is coming out in just under an hour, under an hour, excuse me. So if probably only going to be impactful if you're trading the Canadian dollar, to be quite honest. So we're watching out for that in an hour. Not going to have much of an impact probably on most of the markets you guys are looking at. And then we've got CFTC stuff in here. So nothing really significant, a fairly quiet end to the trading week with respect to the data front. What's going on in the macro fundamentals? Well, let's have a look at 5 things to start your day. So Putin has been introduced to a victory in Ukraine's east. So we know this has been going on. They're switching across to the east of Ukraine. And this is interesting as well. So this is on Forex Live coming out today. Remarks from the Kremlin. Russia says special operation in Ukraine could be completed in foreseeable future. Aims are being achieved and work carried out by military, peace negotiations. Okay, so I don't know, how to take this really. The markets haven't had a big reaction to this. For me, this seems to like they're trying to get exit strategy, right? But I mean, who knows? It could just be smoke and mirrors. But nevertheless, I mean, I would say this is probably a positive, a slight positive. We know they're switching to the eastern regions and those regions that have been in civil war anyway. So there may be, who knows, an exit on the agenda. I mean, not anytime soon. I'm not expecting it today, but, foreseeable future, who knows? And, are we going to believe what they say anyway? So, so I thought that was interesting, though. I saw that pop up today. But, yeah, so Putin, so we're certainly seeing a shift there. European Union agreed to ban coal imports from Russia. Okay, first move targeting crucial energy revenue. Okay, so there's a couple of other articles on here. Where are we? Here it is. EU adopts new sanctions against Russia, including coal import ban. And then again, the EU formally adopts new sanctions against Russia, includes coal import ban. It's coming from the beginning of the week. We expected it. It's nothing new, but it's like, more of the official announcement. So nevertheless, more sanctions. So potentially negative for global economy, you could say that is. But I mean, markets, again, not particularly reacting in a negative way to that. Surging salaries. UK companies starting seeing salaries rise at the fastest pace on record, okay, because of the tight labor market. So another factor now, wage costs spiraling on top of, we've seen obviously inflationary pressures from commodity markets, from energy markets. So, and just elsewhere, various components. So, not only got price pressures, but now cost pressures coming through from wages. That's been seen in the UK. No reason to think that's not coming elsewhere on the planet as well, and in the world's great major economies. And there's growing concerns about the crisis in Shanghai. Well, not the crisis, the lockdown in Shanghai. And could it be a challenge to President Xi Jinping since he took power? A biggest challenge for him. Big lockdown, and also that's having an insignificant impact on, potential future impact again on supplies coming out of China. What else do we have in here? US futures steady. So what's going on right now? Well, slightly up. We had a rebound yesterday. Markets obviously looking very, very negative throughout this week. The stock indices notably lower, being driven lower, as we've been discussing all week, by the definite shift from the Fed to a more hawkish stance, an even more hawkish stance. So we've seen obviously impacts on it from Lyle Brainard saying earlier in the week, and then confirmation from the meeting minutes. And then you see in here comments from Bullard yesterday, sees 3 to 3.25 rates by the end of this year. We noted Bullard speaking yesterday. So, but what we've seen in here is, bond yields in here actually stabilized a little bit yesterday. However, going back to low prices, higher yields in here overnight. So if we go and take just a quick dip into, here we go. So we did stabilize yesterday. So that was Laura Brainard back on Tuesday. Wednesday was then on the Fed. The market went lower, and then we rebounded through the Fed and put this kind of hammer pattern in. Looked like we're going to be more solid. And then yesterday we were initially bounced and then sold off towards the close, and lower this morning. So we're actually back down to the lows that we saw earlier this week. Remember, this is low prices, and if I quickly, hopefully it'll just open up. I won't have to go and find it. Let's see if I've got the investing. Oh no, it won't take long to get there though. To the bonds in here, if we look at the 10-year bonds, and we'll see the same on yield, right? It's just the upside down, chart really. I mean, it can be slightly different in here. That we see on the actual the price on the futures chart. It's going to be very, very similar looking chart in here. So if we go to take a look at the US 10-year yield as it opens up, and we put it onto here we go. So look, actually making new high yields in here this morning. However, that hasn't had a negative impact on stocks. Previously when we saw this surge in yields that we saw Tuesday through Wednesday, that was particularly damaging for the stock indices. Not so damaging. And yesterday stocks started off weaker on the back of Tuesday's sell-off, then Wednesday's further sell-off after the Fed. Started off weaker and rebounded yesterday. It wasn't an aggressive rebound, but they were down on the day and ended up on the day. And if we see in here, go to stocks, where we ended up on stocks, and there's Europe. Let's have a look on here we are. So here, cash indices in here, the Dow, the S&P up between 0.25% yesterday, having been either flat or down on the day. The Nasdaq was significantly down on the day at one point yesterday, and ended up slightly up on the day. So certainly a positive there. And you can see follow through this morning on the futures markets, up between 0.25, 0.35% in here, a quarter and a third of a percent this morning on the overnight rebounds that we've seen in European stocks. So European stock indices look notably higher in here, around 1 to 1.5% higher. But remember, they closed earlier, so they're getting a bit of that bounce from last night, the late bounce that we saw from the US and the late session bounce in the US, and then but also pushing higher this morning and dragging those futures up, those US futures up. So certainly a decent rebound. The European stocks have actually headed in relatively better than US stocks in here over the last 3-4 days, 3-4 sessions. We look at the FTSE, for example. I'll just look at it here rather than going onto the Trader 8 chart, because we're not going to do a load of analysis on it. But you think what's happened on the S&P, right? If we're going to take a look at the FTSE in here, you can see the FTSE is pretty much on the highs, on the recent highs. Haven't had that big retracement in here like you've seen elsewhere. So certainly you've got to see that as a positive in here. And obviously the fact that rates are going more aggressively higher in the US is why US stocks have been more damaged, with a slightly more dovish tone coming out of Europe. Not so much in the UK, but nevertheless UK stocks holding in. A couple of other little things I just wanted to point out in here. So US futures steady, we already kind of covered that one, and obviously Treasuries they're mentioning here as well. Treasuries dips, that's dip in price, lower in price, higher in yield, which we've already covered. But global inflation in here, another thing which we just spoke about the cost push, but on the prices side in here, global food prices, according to the United Nations, their measure surging at the fastest pace ever, as Ukraine chokes crop supplies in here from Ukraine and to an extent Russia as well. So the United Nations index of world costs surging another 13% last month. So Ukrainian ports closed, etc., etc. So certainly that's going to put upward pressure on prices elsewhere. European stocks rebound. Dollar index is at 100. I'm going to talk about that in a second. Actually, I'm going to switch to the charts in a second. Just a quick nod to the Fed tool. So here up at 80%. We looked at this yesterday, got up to 80%. So in the aftermath of Brainard's comments and then the Fed minutes, nailing on, we've got a real good chance now, pretty much nailing on a 50 basis point hike at the next meeting, and obviously starting the reduction of the bond purchase program and normalizing the balance sheet. Let's take a look at that dollar index first. We'll take a look at the Treasuries. The Treasuries moved to lower prices. We already mentioned that higher yields. Before I go look at the stock indices in here, let's take a look at the dollar index. And here we have the dollar index. So they're hitting 100 in here. This is the future, obviously. Future not quite hitting 100 yet. High has been 99.98. But I think the cash has hit, and the cash index on the dollar index has hit 100. Its highest point, what did it say in there? God, I can't remember where it was in here. Which one was it? Oh, I think it was I think I've moved. Oh, there it is. Dollar index hits 100 in here. I think it says for the first time since, where is it in here? First time in nearly 2 years. So the dollar's at its strongest point. Now, the euro isn't at the low versus the dollar. It's not far off its recent lows versus the dollar. So it's not just all being driven by euro. It's just across the board in here. But also remember, dollar yen is very strong in here as well. So the euro is near to recent lows. It's been down close to the lows that we saw at the beginning of March. But what we're really seeing is that the dollar is broadly strong as well. It's not just, and we've seen, even though the dollar was previously, we saw some dollar weakness versus say previously versus say Australian dollar. So through this whole risk on theme that we're seeing through March into early April, the risk currencies, the Aussie, the Kiwi, the Canadian dollars, have all been strong versus the dollar. They've kind of retraced. So we've seen the dollar strengthening against the risk currencies. It's strengthening against pretty much across the board. It's stronger against the risk currencies. It's stronger against the safe havens, against the yen, and it's strong. It's re-strengthening against the yen, and it's strong against the other reserve currencies, the euro, the pound. So we're seeing the dollar strengthening everywhere, and hence going back to that chart in here, dollar index at 2-year high in here, breaking, continue to edge higher throughout this week, and that's being driven obviously by yields. There's a correlation, a strong correlation with US yields. Yeah, US yields go into multi-year higher yields, low prices, high yields, and seeing the dollar following suit. Yeah, because the dollar just is following the fact that it's more attractive to hold dollars, because of the higher interest rate, the higher future interest rates. So so we're seeing dollar strengthen across the board. Let's while I'm in here, I'll just go through the commodity markets. So we take a look first of all daily on oil. So even though this has been erratic, the theme has been lower in here for oil. We did manage to rebound from above this low. We looked at this yesterday, said did feel like the risk was lower. We did see an initial push lower and then a rebound, but lower again here this morning. You can see we're holding this low over here. You've got the impulse low in here, just held right at that impulse low. That impulse low from the 17th of March, the low there was 93.41, and we came off of 93.81 yesterday, and that the actual low, the swing low there, so the impulse low is 93.41, the swing low is down at 92.20. So those are going to be important. If we go through there, we can see a real acceleration on the downside, and we've still got some way to go because we had that rebound yesterday, but it has rolled lower. And if we go to the 30-minute chart now, you could argue this is the market's trying to base, but really to get a proper base going, it's got to get at least back up and get above. This is a 30-minute chart, back above that peak there. Remember, we had the breakout from this. We looked at this consolidation range, kind of got a similar consolidation going here, and look at that big impulsive breakout. I wouldn't be surprised to see another impulsive move to the downside in here. We're already flirting with, if we look at these little kind of, if you look at this, you've already broken kind of through this one here on the downside in the last hour or so, right? So we've had this kind of recovery effort, lower low, lower highs, and then the market already faltering. So back down through the recent low just here could be your trigger in 95.76, or maybe through that impulse low just there, that one just there where I've joined the trend line off of 95.43, and then you got the actual swing low in here 95.29. So those could all be triggers in. I'm talking minimally back to the low in here, but as we said, it opens up risk. We go back to yesterday's low and then all of a sudden this impulse lower and this swing lower in play. And if it breaks these, could easily see another couple of dollars to the downside as we run some stops through there. Let's have a look at gold. You probably guess where I'm going to go with this. I mean, it couldn't be more sideways. I mean, I just don't think this is tradable. I mean, if you're trading this, hats off to you. But I mean, it's just, up and down. I wouldn't be touching this at the moment. I think it's really tricky. So no view there, really. Let's take a look at stock indices. We've already given a nod to the Treasury market. So despite Treasury, unless you see an acceleration here in Treasuries, I think stocks could hold in, right? So the stocks, not really reacting. So that's a positive for stocks. If you get any rebound in here, this is going to be super positive for stocks, okay? So even if they just gradually go lower, stocks seem to be happy, they're discounted in, but you don't want another bar like this. I mean, it'll be disastrous for stocks. But I mean, if we just hold in, it's kind of gone down. It just undercut. You can see in here, we've just undercut the low there. From 2 days ago. So Wednesday's low, that's the Fed minute low. And then we've just undercut and rebound. I mean, just undercut. And if we go and take a look in on the 30 minute I've got here, so there's the low there. It's just undercut that low. Look, and you've got this real big rejection candlestick. It went down towards the low, actually. This is the Treasuries. I know a lot of you are not necessarily trading this. So the low in here from back 2 days ago, this is after the Fed. The low there was 120.05 and a half. And then we went down to 120.05. So we just pipped below that. And then, just got below this low and just went below that low and then rebounded. And then you went back down there, like flush below. And then again, so you've had two rebounds, now, two tests of this low from 2 days ago. That's the Fed low. And then the market bounces once and again, just undercuts and bounces again. So, I mean, I do think these are real risk. This is a turning point for Treasuries. I'm not saying, I'm not, bullish Treasuries. Still think there's probably further downside, but this could be the beginning of at least a consolidation phase. And again, I think this is important to us. Even if you're trading stocks, guys, the correlation is there. Yeah, that when this has sold off, this has been negative for stocks. There's a positive correlation at the moment, right? The long-term natural correlation is an inverse correlation between bonds and stocks, but from an economics perspective. But at the moment, from a trading perspective, these are correlated in a positive way. The big sell-off has seen the markets. The big sell-off in Treasuries has seen a big sell-off in stocks as we've gone to higher yields, and then as the market stabilized in stocks over the last day, stocks have tried to rebound. And I think if this rebounds, now I would definitely be looking at this trend line here. Where are we? Why am I not? It doesn't annoy me when this happens. Oh, there it is. Didn't see it. Here we go. If we can look at this, a good trend line as well. Off this peak in here from yesterday, and then off the peak here, and then you see you get another touch here, basically moves away, and we're coming up and flowing. If we get back above here, we can easily see a short squeeze going on. You've got a lot of shorts in here on the Treasuries, right? And they're just you've had new shorts probably squeezed into short positions in here just this morning on that move that we just seen. So you've got all these shorts from the last week and a half, right? They could easily get popped out in here going into the day, and you've got fresh shorts in here on this impulsive buy. There'll be fresh shorts here looking for a move up as we've broken this low from Wednesday. Didn't get it. And then they had another go, didn't get it, right? So we could easily get a short squeeze going on. I mean, up above that trend line is your first trigger. Up above these peaks in here, 120.16. Now, given the correlation, I think you have to have this chart open, even if you're trading stock indices. Okay, if this starts to break on the upside, it's gonna really help the stocks. Right, let's take a look at those stock indices while we're here. We looked at this the last 3-4 days in here. That 38.2% went down to it on Wednesday, went down to it again yesterday, and rebounded from it. And look at this, we're back up to yesterday's high already on the S&P. And if we go into a 1 hour chart, there we are. Look, I'm actually just above yesterday's high. So we managed to just nick above yesterday's high and pushing higher again. I think this is, you have to play this from the long side from my point of view going into today. I know you probably guys feel like I'm the eternal bull, but nevertheless, this is a basing pattern. You've got a double bottoming down here on stocks now, 1, 2. It's been confirmed above this high here, these two highs here. Double bottom confirmed, and then the market comes back, gut checks the double bottom, and then it's gone higher again and made another new high in here. Got a little gut check again in here and swinging higher. There's your next trigger point. Either above the current high for the day, which is 45.1975, or the peak here, 45.2875. This could easily be back up here. We could be 45.70.80 today. Again, short squeeze. Could easily see a short squeeze. Watching that Treasury market as we've just highlighted. Nasdaq, not as positive. Been more negative for the Nasdaq on the way down. But again, look, held the 38.2 on Wednesday, undercut it yesterday, and came back above it. positive hammer pattern on the daily chart. Back up, nudging towards yesterday's highs in here already this morning, right? Let's zoom in. This has been underperforming, obviously, because of the higher yield pressures, higher yields, higher longer-term interest rates, negative for growth stocks more than the broader market. So hence the growth, the NASDAQ, which is a growth-heavy index, has suffered more. It could easily, if we get a turnaround in the bonds, now this should and could lead the way back higher. So let's take a look at the peaks in here. I'm going to zoom out. I've got it on a 15, so it's come out a little bit. I'm going to go back out to that 1 hour chart, see how that looks. So here we are. So in this, not so much a double bottom in here. You could argue a sort of convoluted head and shoulders, shoulder, inverse head and shoulder, shoulder, head. Is this another shoulder in here? You've got kind of a natural kind of almost a horizontal neckline going across here. And we've already had a go at piercing that, pierced it, dip back lower, holds these swing lows in here, swings back lower on the 1 hour chart, a little hammer pattern pushing higher. I think back above that neckline or back above the peak here. Did we get above this peak here? No, we haven't. So back above that peak there, the peak from today, 14,642.25, and then this peak over here from the 6th, that's 2 days ago, that's Wednesday. So we are 14,652.75. These are what would be your trigger points. Then you've got a kind of inverse head and shoulders. Maybe it's a double bottom, whatever you want to call it. It gets triggered certainly above this peak here, gets confirmed. We've already kind of indicated a break higher. It get back above this kind of neckline. Then again, this could be easily up here, like 14,850, 14,900 kind of area. I wouldn't be surprised to see a more aggressive short squeeze. No data to drive it. Short positioning, though, the market is certainly short treasuries. It's, you know, the fast money. I'm not saying the big long-term money. The fast money is probably short treasuries. But even short-term money is short today, okay? Even short-term money, but the real fast money, the hedge funds are probably short treasuries now. You know, we could get a little bit of a short squeeze in here. So, you know, and you've got the big unknowns over the weekend, you know, with those comments from Kremlin. You know, if you had short treasuries, would you want to be going home short? So get a squeeze in the treasury. You could easily get a squeeze on the stock indices as well. I wouldn't be surprised to see that. Okay. TGI Friday. I'm going to wish you all a great trading day, a fabulous weekend. I'll be back with you with another Bull versus Bear webinar on Monday. Take care.